Welcome to The Explainer. If you've been watching the commodities market lately, you already know that something absolutely historic is happening. So today, we are going to decode a massive financial mystery unfolding right in front of our eyes. We're unpacking the structural paradigm shift that is completely transforming the global gold market. We're going to peel back the layers, look at the hidden hands driving this record rally, and really dig into this fascinating story of geopolitics, high finance, and a rapidly changing world order. Okay, let's just dive right in with a number that is honestly kind of staggering. 20%. Since mid-August, the price of gold has climbed over 20%, and recently it's surged past the extraordinary $4,000 mark in this 2025 rally. Now, for an asset that's historically viewed as a slow, steady store of value, a move of this magnitude is absolutely seismic. It's the kind of explosive growth you normally expect from, say, a high-growth tech stock, right? Not a physical metal. Which brings us to a massive paradox. If equities are booming, why in the world is the ultimate safe haven asset breaking records? You see, under normal market conditions, there's a pretty distinct playbook. When global equity markets are strong and interest rates are relatively restrictive, gold just shouldn't be behaving this way. Usually, investors flee to gold when stocks are crashing or yields are sitting at basically zero. But right now, we're seeing exceptional equity market strength right alongside record-breaking gold prices. So, what exactly is broken in the traditional financial playbook? To figure that out, we have to look at who is actually doing the buying. Historically, the old market drivers relied heavily on jewelry demand and retail buyers, groups that are highly sensitive to price and affordability. When gold gets too expensive, they usually step back and wait for a dip. But today, the new market drivers are central banks and massive institutional investors. These are the hidden hands we're talking about. They aren't trying to time the market or score a quick profit on a tiny price dip. They are accumulating gold to protect national wealth and secure strategic insurance. And crucially, they're buying regardless of the current price tag. This shift in the balance of power is literally a game changer. Just look at this breakdown of total gold demand. Central banks and investors now make up 52% of the entire market, over half. To put that into perspective, just a decade ago, those same groups accounted for only about 1/3 of total demand. That is a massive jump. The market is fundamentally less dependent on those price-sensitive jewelry buyers now, and it's structurally anchored by these institutional heavyweights. The geopolitical catalyst. So, to understand why these massive institutions suddenly decided they needed all this gold, we have to look back at how this built up over time. Over the last 25 years, gold has gone through some very distinct phases. The first big shift happened right after the global financial crisis in 2009. Central banks fundamentally altered their monetary policy, introducing unconventional tools like quantitative easing. That was the exact moment they shifted from being structural sellers of gold to becoming buyers. But the real turning point, the absolute wake-up call, hit in 2022. Following the outbreak of the Russia-Ukraine war, Western sanctions immobilized over $300 billion in Russian foreign reserves. That sent massive shockwaves through the global financial system. The result? By 2024, net central bank gold purchases more than doubled, surpassing 1,000 tons on a yearly basis, heavily driven by Asian and emerging market central banks. And the core of that shockwave boils down to a pretty harsh reality. Gold held domestically carries no counterparty risk, and it remains completely beyond the reach of foreign sanctions. When $300 billion of sovereign wealth gets frozen overnight, central banks around the world take notice. It sent a crystal clear message. Dollar-based assets, no matter how traditionally secure we think they are vulnerable to geopolitical pressures. If you don't physically hold the asset, you don't truly control it. And that single realization sparked a massive global rush for reserve sovereignty and de-dollarization. Let's actually break down the specific rationale driving this, because there are 7 distinct layers fueling this allocation. Reserve managers are looking at economic stability during weak macro conditions, and they're using gold as a hedge against inflation risk and fiat currency devaluation. They're also heavily prioritizing reserve diversification to reduce their dependence on the US dollar, alongside some very deep cultural factors. Add in the need for protection during global uncertainty and geopolitical fragmentation, the growing fear of US dollar debasement from expanding debt and deficits, and finally managing price volatility, since gold has always served as a universally accepted store of value. So the big takeaway here is this. When you weave all 7 of these layers together, it proves that reserve managers are prioritizing sovereign security and long-term risk management. They are completely looking past daily price fluctuations. The FOMO factor. But here's the thing, it doesn't just stop with central banks. As they lay down this massive structural floor, private, institutional, and retail investors are deciphering the playbook, and they are jumping in with both feet. I actually love this quote from the Saxo Bank research because it perfectly captures the current market psychology. Momentum-following investors and underallocated portfolios are increasingly being drawn into the market by fear of missing further upside. Basically, fear of missing out is taking the wheel. Gold's strong price performance has become a driver all on its own. Because of this momentum, global physically backed gold ETFs just recorded their largest monthly inflow in September 2025, culminating in their strongest quarter on record at a staggering $26 billion. Investors are looking at what the central banks are doing and realizing, hey, we are way underallocated here. So why exactly are everyday and institutional investors copying the central bank strategies? Well, first, they want hard asset protection against unsustainable fiscal debt. Second is inflation resilience. Even if headline inflation cools down, there are serious structural costs coming from the energy transition and supply chain fragmentation. Third is TINA. There is no alternative. Think about it. Equities are stretched to new highs, bonds are really struggling to provide diversification in inflationary environments, and cash is actively losing its purchasing power. Finally, investors want protection against stagflationary scenarios, those dreaded periods where the traditional correlation between stocks and bonds just completely breaks down. Gold sits right there in the middle as the ultimate structural portfolio diversifier. And all of these combined forces are pointing toward a pretty staggering climax, $5,000. According to target projections from Amundi Research, this persistent structural change in demand, driven by both investors and central banks, has the potential to push gold to $5,000 an ounce by the end of 2028. This isn't just a cyclical blip. It's a fundamental realignment of how global wealth is being stored and protected. Which leaves us with a huge, frankly, provocative question. As we transition to a multipolar financial system, what happens when a superpower's currency becomes a weapon? This record rally in gold isn't just about supply and demand on some spreadsheet. It is a real-time indicator of a world transitioning away from a US-centric international monetary system, moving toward a much more fragmented, multipolar reality. The hidden hands are preparing for that future right now. It is going to be absolutely fascinating to watch how the global monetary system evolves from here. Thank you so much for joining me for this explainer. Keep your eyes on the markets and never stop learning.